On January 14th, 2026, a regional bank in Pittsburgh filed what is called a troubled debt restructuring notice with the FDIC. The filing was 127 pages long, buried in regulatory documents that almost nobody reads. On page 89, in a table labeled Loan Portfolio Composition, was a single line that should concern anyone paying attention to the financial system. Commercial real estate loans, $4.2 billion. Non-performing assets, $1.8 billion. That's 43% of their CRE portfolio in default or serious delinquency. This isn't an isolated case. It's a preview of what's coming for hundreds of regional banks across America. Between 2024 and 2027, $1.5 trillion in commercial real estate loans are maturing. These loans were originated when office buildings were 95% occupied, when interest rates were 3%, when remote work wasn't a permanent reality. Today, office vacancy rates average 19.6% nationally and exceed 30% in cities like San Francisco and Austin. Interest rates are 7%, and companies have realized they don't need nearly as much office space as they thought. Disclaimer: this analysis examines commercial real estate market data and historical patterns. Outcomes depend on economic conditions, Federal Reserve policy, and market dynamics that are inherently unpredictable. This is educational content, not investment or financial advice. Consult qualified professionals for personal decisions. Now, let's understand why this matters and who gets hurt when the maturity wall hits. The current situation. Commercial real estate is not a monolithic category. It includes office buildings, retail shopping centers, apartment complexes, industrial warehouses, hotels. The crisis is concentrated in office buildings, specifically Class B's and Class C office space in secondary markets. Here's the data. According to CoStar, the leading commercial real estate analytics firm, national office vacancy rates hit 19.6% in Q4 2025. That is the highest level since they began tracking data in 1995. But the national average obscures the real pain. In San Francisco, office vacancy is 31.4%. In Houston, 28.7%. In Austin, 26.3%. Even New York City, traditionally the most resilient office market, is at 22.1%. These aren't temporary pandemic disruptions. This is the new structural reality. A study by Stanford economists published in December 2025 found that 62% of major corporations have permanently adopted hybrid work policies. The average company now needs 35% less office space than in 2019. Here's the math. If you're a landlord with a 200,000 square foot office building that was 95% occupied in 2019, you now have sustainable demand for only 130,000 square feet. The other 70,000 square feet is structurally vacant. Your rental income has fallen by 35%, but your mortgage payment hasn't changed, your property taxes haven't changed, your maintenance costs haven't changed. You're losing money every month. And worse, your loan is about to mature. The maturity wall. Between 2020 and 2022, when interest rates were near zero, property owners refinanced aggressively. They took out 5-year and 7-year loans at rates between 2.5% and 4%. Those loans are now maturing. According to the Mortgage Bankers Association, $1.5 trillion in commercial real estate loans mature between 2024 and 2027. The peak hits in 2026, this year, with $550 billion coming due. When these loans mature, property owners must either: Option 1, refinance at current rates, 7% instead of 3%. Option 2, sell the property. Option 3, default and hand keys to the lender. Let me show you why each option is problematic. Refinancing requires the property to appraise at a value that supports the loan amount. But office building values have fallen 35-50% in many markets. A building worth $100 million in 2021 might appraise at $60 million today. If you owe $80 million, the bank won't refinance without you bringing $20 million in new equity. Most owners don't have $20 million sitting around. Selling means realizing the loss. You bought for $100 million, you owe $80 million, but the market value is $60 million. You'd need to bring $20 million to closing just to pay off the loan. Again, most owners can't do this. Defaulting means the lender takes the property. The lender, usually a regional bank, now owns a half-empty office building in a declining market. They must market to market value, realizing the loss on their balance sheet. This is how bank failures begin. Which banks are most exposed? Not all banks face equal risk. The exposure is concentrated in regional and community banks. According to FDIC data from Q3 2025, banks with assets under $10 billion, CRE loans represent 28.7% of total loan portfolios. Banks with 10B, $250 in assets, CRE loans represent 18.4% of portfolios. Banks with over 250 buys in assets, the big national banks, CRE loans represent only 6.3% of portfolios. The big banks, JP Morgan Chase, Bank of America, Wells Fargo, are relatively insulated. They have diversified loan portfolios across geographies and asset classes. Regional banks, especially those concentrated in office-heavy markets like New York Community Bank, Western Alliance, or Valley National Bank, are heavily exposed. The Federal Reserve's November 2025 Financial Stability Report flagged this explicitly. Quote, banks with high concentrations of CRE loans, particularly office properties, face elevated credit risk as loan performance deteriorates and property values decline. Translation, some banks are going to fail. Historical precedent, the 1980s. This isn't the first commercial real estate crisis. In the 1980s, a similar dynamic played out. Tax law changes and an oil price crash created a commercial real estate glut. Office vacancy rates in Houston hit 30%. Property values collapsed. Between 1985 and 1992, over 1,400 banks failed, many due to CRE loan losses. The crisis was particularly severe in Texas, where oil-dependent economies amplified the pain. The Resolution Trust Corporation was created to manage failed institutions. The government ultimately spent $132 billion 1990s dollars resolving the crisis. But here's the key difference. In the 1980s, the crisis was regional, concentrated in the oil patch and overbuilt Sunbelt cities. Today's crisis is structural and national. Remote work isn't a regional phenomenon. It affects every office market simultaneously. The international comparison, Japan's 1990s. There's another historical parallel. Japan's commercial real estate collapse in the 1990s. During the 1980s bubble, Japanese commercial real estate prices quintupled. Banks lent aggressively against inflated property values. When the bubble burst in 1991, property values fell 60% over the next decade. Banks were stuck with non-performing loans backed by properties worth far less than the loan amounts. Japanese banks became zombie banks, technically solvent on paper, but unable to lend because their balance sheets were clogged with bad real estate loans. The result, Japan's lost decade of economic stagnation. The U.S. isn't Japan. We have different banking regulations, more aggressive central bank intervention, and better bankruptcy resolution mechanisms. But the core dynamic is similar. When property values fall sharply and banks are heavily exposed to CRE, the result is a prolonged credit crunch that ripples through the entire economy. 4 scenarios. Let's examine how this could unfold. Scenario 1. Extend and pretend banks and borrowers negotiate loan extensions. Instead of forcing refinancing or foreclosure, banks extend maturities for 2 to 3 years, betting that office demand recovers and interest rates fall. This buys time but doesn't solve the structural problem. If remote work is permanent, extending a loan on a half-empty building just delays the inevitable loss. Probability, moderate. This is happening now. Banks reported $84 billion in loan modifications in 2025. Historical parallel. Japan's approach in the 1990s. It didn't work well. Scenario 2. Orderly conversion and repricing. Office buildings are converted to residential apartments, hotels, or mixed-use properties. Some properties are demolished. Prices adjust downward but stabilize at new equilibrium levels. Banks take losses but remain solvent. A few weak banks fail, but systemic stability is maintained. Probability, moderate to high. This is the soft landing scenario. Historical parallel. Post-2008 housing market adjustment. Painful, but managed. Scenario 3. Regional banking crisis. Loan defaults accelerate faster than banks can manage. 20 to 30 regional banks with heavy CRE exposure fail over 18-24 months. The FDIC arranges mergers or liquidations. Depositors are protected, but shareholders and bondholders take losses. Credit availability in affected regions contracts sharply. Probability, low to moderate, requires economic deterioration beyond current baseline. Historical parallel. 1980s S&L crisis severity. Scenario 4, systemic contagion. CRE defaults trigger broader credit contraction. Banks pull back lending across all categories. Commercial bankruptcies rise. Unemployment increases. Recession deepens the crisis in a negative feedback loop. Probability, low. Requires policy failures and multiple simultaneous shocks. Historical parallel. Elements of 2008 severity. W2 gets hurt. The pain is not evenly distributed. Building owners. Many will lose their equity entirely. A building purchased for $100 million with $20 million down is now worth $60 million. The owner's $20 million equity is gone. Regional bank shareholders, banks with heavy CRE exposure, will see stock prices collapse. Some banks will fail entirely, wiping out shareholders. Local economies, cities dependent on office worker spending, restaurants, dry cleaners, parking garages, retail near business districts, face sustained revenue declines. Commercial real estate workers, brokers, property managers, leasing agents face reduced commissions and potential job losses. Who doesn't get hurt? Bank depositors. FDIC insurance protects deposits. Residential real estate, mostly. Single-family homes operate in a different market. While some spillover effects are possible, residential real estate isn't facing the same structural demand collapse as offices. Large national banks, JP Morgan, Bank of America, Wells Fargo have minimal CRE exposure. They may actually benefit by acquiring failed regional banks at discount prices. The bottom line, the $1.5 trillion maturity wall is real. Office property values have fallen 35-50% in many markets. Hundreds of billions in CRE loans are underwater. This doesn't mean immediate financial system collapse. It means a prolonged period of loan losses, bank stress, and economic drag in office-dependent markets. The FDIC will likely need to resolve multiple regional bank failures. Some property owners will lose everything. Credit will tighten in affected regions. But this is a slow-motion crisis, not a sudden crash. The 2008 financial crisis happened over weeks and months. The CRE crisis will unfold over years. The lesson from history. These situations are survival at the system level, but devastating for individuals caught on the wrong side. If you're a depositor at a regional bank, understand your bank's CRE exposure. You can look this up. Banks disclose loan composition in quarterly reports available on FDIC's website. If you're a commercial real estate investor, understand that we're in a repricing cycle that may take 3 to 5 years to complete. If you're a regional bank shareholder, understand you're holding the riskiest asset class in the current environment. The maturity wall isn't coming. It's here. The question now is how orderly or chaotic the resolution will be. Subscribe for ongoing analysis of financial system stress, real estate markets, and economic risk. We track the data others ignore until it's too late. Thanks for watching.